Hello there. Welcome to the second quarter 2024 video review of the iSectors Capital Preservation and iSectors Domestic Fixed Income Allocations. My name is John Koch, iSectors Senior Investment Analyst, and I'm joined by the CEO and CIO of iSectors, Vern Sumnicht. In case you aren't familiar with these models, they are both 100% ETF-based fixed income model portfolios available for advisors to use through turnkey asset management platforms. Capital Preservation is a short-term cash alternative model with an A-plus average credit rating. It holds mostly government and investment-grade corporate bonds with a very small allocation to high-yield corporates as well. Domestic fixed income is more of a core fixed income strategy, holding only laddered bond ETFs in the high-yield, investment-grade corporate, and U.S. Treasury sectors. Both of these models have performed very well in recent periods versus their benchmarks, mainly due to their higher credit quality and shorter duration profiles. As you can see in the chart on the right, however, we've recently changed the average duration of each of these models, given the current interest rate environment and expected Federal Reserve rate cuts this year. We believe that whether or not the Fed cuts 1 or 2 times this year, or even not at all, we're closer to the peak in interest rates than the bottom, and that's why we decided to make the move. Being a short-term focused model, we kept Capital Preservation's duration under 2 years, but we did make a bigger move in domestic fixed income, closer to 3.5 years. This is still well below the Bloomberg Aggregate Bond Index, which sits at about 6 years. However, it's higher than the model's historical average of about 2.5. So we're kind of in between the historical average, but yet well under its benchmark, which is that we're comfortable living in that area. Vern, you've used both of these models before for your clients. Can you explain a little the best way to use each of them?
Thanks, John. Yeah, Capital Preservation, we created it for our clients originally, and it was a placeholder for cash, right? Every advisor has clients. Clients have cash, and they're going to put it in a money market fund, or they're going to put it in a bank, and you're going to forget about it. And you really want to be able to help the client keep his money invested and get an understanding of his entire portfolio. So Capital Preservation was designed as that short-term, high-quality, bond portfolio that can give the client a better rate of return. Hopefully then he can get on money market funds and also have that cash available in the client's portfolio that he can be aware of. And if he changes his mind or when, he can start moving some of that money into equities, or he can, take his distributions from there if necessary. So that's what, Capital Preservation. Domestic fixed income, it's really a little bit different. It's more of a fixed income allocation. I'd use it for my clients if I was going to put 20% in a fixed income core type portfolio or more. I would use this type. I like the laddered bonds. So this portfolio is designed to be a laddered bond portfolio. And that way that, when bonds come due, we can go out and we can extend the maturity. We can also adjust the maturity, as John just described slightly, if necessary, to manage the yield curve, I guess, so to speak. But lately, obviously, there's not a lot to be gained in return by extending your duration. On the other hand, we're going to lose some of that return if rates come down on the short side. So we've kind of reallocated into that space at the about 3.5 year duration period. The returns have been really good. Net of fees, iSectors does have a cost for this model, but net of all of that, we've had great results. And John, you want to talk about that a little bit?
Yeah, I was just going to mention that. So over the last 12 months, both models have beaten their benchmarks. The yellow line here, the Bloomberg Aggregate Bond Index, has been all over the place, just very volatile with that extra duration it has. I would like to point out, so the green and blue lines on here are our two models, Capital Preservation and Domestic Fixed Income. Over the last year, you can see there, the returns are very similar. And that's because their durations were very similar, as we saw on the previous slide. So with the slight tweak in durations we made going forward, this shouldn't continue of the two models having such a similar return pattern. But in this case, last 12 months, that similar return pattern has actually been beneficial for the models and been good, beating their benchmarks, beating money markets, being a better place than cash over the last year. So if you have any other questions, reach out, call us, visit our website, and we'll be happy to talk to you. Thanks.